KPIs, key performance indicators. Yep, not the most sexiest thing to talk about. But this can be the one thing in your business that moves the needle the most this year. Stay tuned because in this episode, we're talking about the 7 key performance indicators every growing business should be measuring. Hello, my friends, and welcome back to the Liquid Digital Marketing Podcast. This is episode 67, and we're talking about 7 key performance indicators every growing business should measure. Key performance indicators, what are these things? For short, they're called KPIs. Basically, what a KPI is a set of quantifiable measurements used to gauge your performance over a given period of time. So that's the technical definition of what a KPI is. So basically, it's allowing you to measure whether you're failing or succeeding. You get to set what your KPIs are, you get to set your goals, you get to set what you measure. So there's a ton of things you can measure. What should you measure and why? And that's what we're going to go over today. First off, why should you be measuring KPIs in your business? Let's look at it like this, with this analogy. Let's say your fitness goal is to lose weight. So every day or every week, you get on the scale and you measure your body weight. This measurement is going to tell you whether what you're doing is working or not. If you had the goal of losing body weight and you didn't measure what your body weight was over a given period of time, you would not know what's working and what's not working. And that's pretty obvious. So your body measurement, your body weight, that measurement is the KPI. And your goal is whatever weight you're trying to get to. So now you know with this KPI what you're trying to target. So that's essentially what a KPI is. So in your business, really, why do you want to measure these KPIs? Well, what gets measured gets done. So if you want to increase sales and you're not measuring your sales, then you're not going to increase sales, or you're not going to know what you're trying to increase. How are you going to set a goal and then hit that goal if you don't measure it? If you're trying to increase the lifetime value of a customer, well, if you don't know what it is and you don't know what the goal is and you're not measuring it, then how could you improve it? Or how do you know if you're improving it or not improving it? The other thing with KPIs, a lot of misconception with KPIs is, okay, you set these goals, you measure these things, and it's kind of like this look back. Did we hit it? Okay, this is our sales goal. Did we hit it this week? Did we hit it this month? And yes, that's good because it's going to tell you how you're flowing, if you're going up, if you're going down, if there's any trends, if you should be doing anything differently. But really, the goal of measuring KPIs is to get good at projecting what the future is going to be. So it's a guessing game, right? When you're measuring these KPIs and you set out to say, okay, this month our goal, or we project we're going to hit this number. And as that month comes to close, you're going to see, did we hit it? Did we not? Did we project high? Did we project low? If we projected high or projected low, why did we project that? Now you're going to get better at knowing what the future holds as you start to project and you start to see what to expect. And now you can predict the future a little bit better. Okay, so that's some reasons why you want to start measuring KPIs. So with KPIs, there really is no limit to what you can measure. But here are some typical types or categories of KPIs that people typically measure. So broad categories like financial, your customers, so like customer experience, your customer satisfaction, your customers' lifetime value. There's a million different things in that, but your customer data, performance, right? So how is your company performing? How are your processes performing? How are your employees performing? Which brings us to the next one, employee status. How are your employees performing? How long are your employees staying with your company? Do you have an employee churn rate? Do you what's your employee status, like their satisfaction? So you can measure these things and understand what's working, what's not working, and then you know what needs fixed. And by fixing this and knowing these things, then you can start to make things better. And you can start hitting your goals, and this is the whole point of the KPIs. So that's some general things to measure. So what KPIs should you be measuring in your business? Okay, so it's going to be different for everyone. One of my business coaches, Gary Bird, said this to me, and I thought this was really brilliant. If you were on a deserted island, what numbers or indicators would you need to see to know if you're succeeding or failing? So what is that? Like, if you could only see, certain numbers, what would you need to know to really, just by looking at numbers, to know what's working and what's not working, and if you're succeeding or failing? And we'll talk about succeeding and failing in a little bit, but let's talk about some of the typical things, if you're not measuring, that you should start measuring. Number one is total revenue. Okay, so this is going to be some money talk, and I'm not a money guy by any means. Like I have to do some Googling. I have to do my research. This is not my background, and for a lot of entrepreneurs, like the financial part of it is not. But you still need to understand it, right? So total revenue. Total revenue is the total amount of money received for goods or services provided. So basically, it's the total number of money your company has made. It doesn't take into account any expenses or anything. It's just all of the money that came in. So why is that important? Well, it's going to allow you to know how your business is really doing, just overall big picture. It might also be an indicator whether you should be reevaluating your prices on your different services, right? So you can kind of adjust your prices if you need to adjust your revenue. And then you're going to see overall trends and capture your business's progress over time. So this is kind of just like the big umbrella, how much money are we bringing in? Okay. So the next one is sales. And this is where it kind of gets a little tricky, because how is sales different from revenue? And a lot of times it is kind of used intermixed or interchanged. So what sales is basically it's the proceeds a company generates from selling goods or services to its customers. So sales are always a part of revenue, but it's not the other way around. You might have other forms of revenue that aren't necessarily sales, right? So let's say you sold off some equipment this month, right? So that's going to go into your sales. And let's say, and then you have your other sales that you sold, your products or your services. These are all like the cash flow coming in, the sales for this given period of time, a week, a month, a year, a quarter, whatever. That's the amount of money that came in from selling something. So what wouldn't necessarily be a sale? Well, it could be reoccurring revenue, right? So let's say it's not a new sale, it's just reoccurring. So let's say, like for us, we provide hosting. So our hosting that is charged monthly wouldn't necessarily be sales, because it's not a new sale. It's not cash goods. It's a reoccurring revenue. Now, let's say we had a setup fee. That setup fee would go into our sales. So that's sales. So it does get a little confusing, like revenue and sales. And sometimes those numbers can be the same. Sometimes they're a little different. But that's tracking sales. The next item is gross profit margin. Okay, so basically the equation to get this is taking your gross profit and dividing it by your revenue. So your gross profit margin shows you exactly how much revenue your company has after you've deducted the cost of sales and how much is left over after operating expenses. So basically, it's kind of like it's the profit margin is what you have left over after you had put out all of your expenses, right? So revenue is all of it without expenses. Profit margin is, or I should say, yeah, profit margin is all of it minus expenses. And now there are, when it comes to gross profit, they do kind of break down into like fixed profit and, I'm going to forget the word, not dynamic profit, but variable profit or income, fixed income and variable income, or I'm sorry, expenses. Excuse me. So there is like some what they consider like expenses, whether it's a fixed expense or a variable expense. But let's just, for the sake of simplicity, let's just call your expenses. That's your gross profit, right? So it's the how much money you made minus how much it costed you to do business. Okay. So that divided by your total revenue, and that's going to give you your profit margin. So higher the better, right? So it's the higher the number that you have in this gross profit is the more profit you've made out of your revenue. So this will help you determine how effective your business is and if it's growing or not. Okay, so that one's a little challenging one. Okay, so we have the next one is the customer lifetime value. So this a short acronym for that is the CLV. This is a measurement of how valuable your customer is to your company, not just off of a purchase by purchase, but over the whole relationship, right? So this one can be a hard one to figure out because it kind of takes in some time that you have to look. So there is some kind of, depending on how your business is set up, you might have to kind of average out what that value is. But basically, how much does a customer spend with you from day one to today? The average lifetime. Do they just pay you one time and never again? Or do they pay you reoccurringly over the course of typically, 12 years, 10 years, a year, 2 months? What are they paying you? And that's the average lifetime, or that's the customer lifetime value. So knowing this will help you understand how much money you should spend to acquire a new customer. So if you know how much a customer is worth, then it's going to tell you how much you should spend to acquire a customer. So let's say the lifetime value of a customer is $1,000 and it costed you $1,000 to acquire that customer. Well, probably not great because you've just spent that same amount to acquire that they brought in. So your net is zero. Let's say that lifetime value is $10,000 and it costed you $1,000 to bring that customer in. Well, now you have made profit off of that customer. Okay, so that's why it's important to know that number. And it's usually like an average, right? It's not always just this is it. It's going to be an average of, a base of your customers. All right, customer retention rate. So there's kind of two parts to customer retention rate. There is customer retention rate and then there is churn rate. And the big difference is the measurement of retention rate is measuring the percentage of your existing customers who remain after a given period. And churn rate is just the opposite. The number of customers that have left over a given period. So you can measure both. Right? So if we're measuring retention rate, it's more of a positive measurement. How many customers are staying over a period of time? So your customer retention rate can help you better understand what keeps your customers with your company. It can also signal opportunities to improve in your customer service. So that's the other one with the customers is how long are they staying with you, which actually will help with your customer lifetime value. Okay, The next one to measure is your new leads and prospects. So with any business that's growing, you need to know how many leads and prospects that are coming in. So setting this as a KPI, okay, this is our goal. Now we also can measure like our close rate, which is the next one, lead conversion rate. So these two kind of go hand in hand. If we know we have a 10% close rate, then we know how many customers we need to get in to hit the new customers that we need. Because we know, okay, if we get 100 customers in and we close 10% of them, then we're going to have 10 customers at the end of that period. Okay, so those two things, the last two then, just to recap, were new leads and prospects and then the lead conversion rate. So here's some bonus tips for success when it comes to measuring your KPIs. The first one is people need to own a number, right? So it's best if a person, depending on how big your company is, most people should only own one number, never more than 3 as a rule of thumb. However, if your company's only so big and you need to measure KPIs, you might have to exceed that number. You're better off measuring than you are, and having to measure more numbers per person than you are just not measuring at all. So the whole point of that is when people measure a number, people take ownership of that number, which I'm going to jump ahead here. If someone doesn't have the power to impact the number, then they shouldn't own it, right? So if I own this number, this is my number that I own, or these are the 2 or 3 numbers that I own. If I don't have the power to make a difference in those numbers, then what's the point? Like if I can't do anything about it. The numbers you measure should lead to action from the team. So if you're measuring these numbers, then the goal and the action to acquire that goal, all of this should lead to action and not give a feeling of helplessness. So if it's like, okay, the goal is so high, we're never going to hit this goal, then you're going to feel helpless. Or if, okay, here's this goal, but I have no ability to impact it, then I'm helpless. I can't do anything with this goal. So what's the point, right? So goals should be to create action. These numbers need to be able to create action, and they should be able to, the owners should be able to adjust and to impact the numbers. Okay. You want to measure your numbers weekly that lead to monthly goals, and eventually you want to measure trending data leading up to your yearly goals. Everyone on your team must know what winning is, and winning is usually measured in a number. So you need to know what winning is, and you need to know what failing is. And these KPIs, they drive ownership when presented in a group setting. So everyone who owns a number should share their number, and that way they have ownership of it. If they didn't hit their number and they're responsible, then they're gonna have to answer to that. So, and that's good. Like, it's gonna create that feeling of like, hey, I need to get this done and create impact. So that's why measuring KPIs and giving ownership to them is huge. Okay, so that wraps us up with our KPI talk. I know this isn't the funnest conversation to have, when we're talking finances and KPIs and measurements and all of this stuff. But you know what? It is really important. And most business owners are not measuring these things, especially small entrepreneurs that are just getting started. They're not measuring. So it's important to measure. It's important to share these numbers with your team and everyone understand what the goal is, what these numbers mean, and what winning is and what failing is. And everyone will be on board and everyone will be driving the ship together. So that's the benefit of measuring these KPIs. If you found this helpful, please share it. We'd love for you to leave a review, and we'll see you in the next episode.